Hello, my name is Mehta Zanam Nofal. I'm going to be giving a presentation on the zero-based budgeting approach. Firstly, I would like to state the budgeting process in itself. The budgeting process can vary per organization presented to the budget committee before final approval. The budget committee is comprised of senior executives, for example, such as sales, production, and purchasing executives. If the budget does not include an acceptable performance expectation, the functional head will need to make additional changes to the received proposal. To oversee and organize the company's budgets, the budget committee employs an accountant. This is the basic structure and how the budgeting process is set up between within organizations. Moving on to stages in the budgeting process. These can be divided into 8 stages. Firstly, communicate details of budget policies and guidelines to those people responsible for preparing the budget, such as the annual reports, the amount of finances needed to predict future sales, to see what the target markets are, how much finance should be allocated in which department and in which aspect. Secondly, determine the factor that restricts output, such as overheads or costs that can be adjusted more financially stably. Thirdly, preparation of the sales budget, as in the statements that the company needs to produce its final reports for public view or for the investors or for its stakeholders. Fourthly, initiate preparation for the budget, such as collecting all of the data and seeing how the process and seeing how the preparation can involve different factors and stages in the financial process in itself. Fifth, negotiation of budgets with higher management, such as how much finance should be allocated to which department, as for example sales, or how much inventory should be taken place, and how much monetary value such departments and such operating costs will be needed to be bared by the company in itself. Sixth, coordination and review of the budgets, as the financial accountant would be able to see how much money is going in and how much cash flow is coming back. Sixth, financial acceptance of the budgets, the final approval of the budgets and how much money has been allocated in which department, that the financial heads have also agreed upon, as well as the stakeholders of the company. Lastly, outgoing review of the budgets, that how much finally is the allocated amount for each department for the budget for the company to have in its budgets for their operations and production. Moving on to the zero-based budgeting approach in itself. The zero-based budgeting strategy analyzes the demand and expenditures of each department inside a corporation. Budgets are developed depending on what is required for the upcoming quarter, regardless of the size. Individuals and families alike can benefit from the zero-based budgeting approach. Each new method, such as month, involves the preparation of a budget. This can be in a form of monthly or weekly or annually or quarterly. Lastly, tracking spending can be done in 2 separate ways, which can be standard or the zero-based budget approach. Moving on to zero-based budgeting used for companies to increase their profits. How they can do this, I've divided how the companies can increase their profits into 3 major categories. Firstly, fat trimming. This strategy encourages MBM focus on elements that allow your company to fat trim and develop long-term financial goals. Finance and cash flow management can benefit from rethinking initiatives, departments, as well as goals. This can be a very vital a category in which the company can save as much capital as necessary, as well as having the appropriate allocated amount of finances towards these departments. Secondly, growth may benefit the organization through achieving goals such as overall growth, profitability, and competitiveness. It is necessary it is very necessary to see how much money in terms of dollars or pounds or ringgits, however the company is dividing its financial accounts, to see how much money is being allocated where, and how is this benefiting the company in its long-term goals and a mission statement. Lastly, reduction of costs. Companies that adopt ZBB as a accounting strategy save money, have more budget flexibility, and execute their plans for financial aims and goals in a more productive and efficient way. And with every dollar evaluated, the top revenue generating operations emerge. ZBB removes resources misallocation. It may result in fewer spending per of the company's allocated resources. Moving on to ZBB and the concept of planning, control, and decision making. These are vital processes in which the company needs to adopt as per their operations and production. All of these activities assist in the company being able to cut expenses and enhance their output. The zero-based budgeting approach is the easiest way to increase business performance while cutting expenditures. Budgeting, employee engagement, and organization collaboration are all involved in ZBB. Businesses were able to employ this approach due to the advancements in planning technology. Businesses can also swiftly integrate into this approach using modeling platforms that are not restricted to specific financial line items. Moving on to budgetary control. Budgetary control can be defined as how expenses are incurred and compared to budgeted expenses for easier budget management by the company itself. Budget control has 5 different categories in which its characteristics can be defined. Firstly, for example, determination of goods, attainment of goals, laying out a plan, making comparisons, and corrective or revision characteristics. Moving on to the ways in which a company can control its budgets. Controlling the company's budgets can be done by a number of different ways. The 2 ways that I would like to be talking about today, firstly, are ratio analysis. Ratio analysis can be defined as comparing multiple financial measures to a country's financial statements, as well as external analysis. Typically utilize them to assess a firm's profitability, liquidity, and sovereignty. The advantages to using ratio analysis are analysis of financial position, forecasting and planning, specifies accounting information, measures operational efficiency, locate weak spots, inter-firm and ultra-firm comparison. Moving on to the next approach which the company can use to manage its budgets, which can be called as CVP. A company's profit is affected by changes in costs. That is how the CVP, which is also known as cost volume profit, can be defined as well. These costs can be fixed or variable. This can be broken down into, in order to break even, earn a profit, or maintain a margin of safety, these data can be employed. The advantages of using CVP analysis consists of: it assists in establishing price of the product, assists in analyzing the impact that volume has on short-term profits, as well as assists in focusing on the impact that changes in costs, which can either be variable or fixed costs, have on the overall profit of the company. Assists in analyzing how the mix of profit affects the overall products and the profits and the overall turnover of the company. Thank you so much for listening.